Welcome to the Capital News. I am your host, Alex Corrales. Today is June 13th, 2019. Thank you so much for joining me. Oil strike and oil spike. And of course, I'm talking about the oil tankers that were struck this morning, over in the Gulf of Oman, of course, near the Strait of Hormuz, where a vast supply of the world's total oil supply is transported. The war drums playeth. Episode 83A, our geopolitical podcast. Check that out today because we have to talk about this. This is something that we were talking about only a month ago when 4 other tankers were attacked on May the 12th. Now it's June the 13th, 1 month later, and we have 2 other vessels that were attacked. Of course, last month we were accusing the Iranians. The Iranians denied it. This month, today, we are already accusing the Iranians in a formal statement from Secretary of State Mike Pompeo. We also have statements from the United Kingdom and Saudi Arabia that they too are accusing Iran for these attacks. This is getting serious, folks. And of course, oil spiked for the day. It was up a few percent. Of course, we're going to get to that here shortly. The S&P closed up 12 points. The Dow Jones Industrial Average gained 102. The Nasdaq closed up 44. The Russell 2000, the small cap index, gained 16 points, representing a 1% gain for the day. The Dow Jones Transport gained 100 points, representing about a 1% increase. And the New York Stock Exchange gained about 0.3% for the day. Oil, after the news of this geopolitical event, spiked. We saw about a 3% rally in WTI and in Brent. We have WTI now trading at $52.38. It did pull back a little bit from its day's high, as did Brent, but it now sits at $61.64. It was just yesterday we were talking about Brent being below $60, and we were saying we still anticipate oil to move downward unless there is some sort of geopolitical event. And boy, did we get one this morning. Because again, the fundamentals at a high level, when it comes to the price of oil, comes down to 4 things. Again, on a high level: supply, demand, the value of the dollar, and geopolitical events. Okay? Now, we've been talking about here for the past couple of months that, again, that word unexpectedly, U.S. stockpiles of oil have just been up, and away. Okay? So that puts supply pressure on the market to have lower oil prices. We've been talking here for a very long time that we have anticipated that there is going to be slower demand globally because we talk about all of the economic puzzle pieces here on a daily basis, and they're painting the picture that the global economy is slowing down. So that has a bad picture for demand. So you have less demand, you got a bunch of supply. That ain't good for oil prices, ladies and gentlemen. You don't need to be an economist to figure that one out. At the same time, you do not have the U.S. dollar trading at any type of low. Now, of course, all of this can unwind in some way, not necessarily the supply or the demand picture on a dime, but you never know what's going to happen geopolitically. And with the Federal Reserve potentially going to cut interest rates, you may see some weakening in the dollar. How long-lived will that be is the question. How long-lived will this geopolitical event be with the Iranians and other nations around the world? Libya, Venezuela, we're still messing around in Syria. Who knows what's going to transpire? I mean, we're even pretty much threatening Germany now. We were talking about this yesterday, that Trump, the tariff man, is now threatening sanctions or some sort of retaliation against the Germans if they decide to take natural gas from Russia through a pipeline. I mean, who are we to dictate to all of these countries around the world? How would we like it if China or Canada or Germany or anybody else for that matter was dictating to us what we can and cannot do? I just don't understand this. I mean, do you think your top dog, the biggest economy, that you can do this? I don't think that's right. I don't think that's what our founding fathers envisioned. I really don't. In fact, I know it wasn't, because it was not about empire. Empire tells other people, other countries what to do, how to do it, when to do it. That's not what this country was founded on. In fact, it was founded on the counter argument of that. Take care of yourself. Be friendly, trade, talk with others, but there's no reason to dictate from on high how others are supposed to be governed. I mean, that is anti-American by definition. We, the people, are our government. We can govern ourselves. That is what is supposed to, that's how we're supposed to lead by example. We're supposed to inspire other countries. Look, we can do this. You can govern yourself. As men and women, you can govern yourself. You do not need a dictator. You don't need it. You don't need some sort of Politburo. You don't need a whole bunch of eggheads sitting around a big table, patting each other on the back, thinking they know better than you. You don't need it. We've proven this. This is why the rest of the world came to the United States of America. They didn't come here to be put under the heel of nasty, greedy capitalists. That's not how it works. They left because that's what they had. They had dictators. They didn't have hope. That's why they came to the United States of America. And now, there are so many things that, there's so many laws, regulations. I don't even know what freedom means. Because, this ain't the land of the free anymore. Just look at the Federal Register. Look at how many state laws there are. You can't get out from under it. It's ridiculous. So this is continuing to escalate. And interestingly enough, and we talked about this again on episode 83A today, that Prime Minister Abe of Japan was actually in Iran today meeting with the Iranian leaders as part of a diplomatic mission, if you will, on behalf, at least quasi on behalf of the United States, to try to sort of tone things down between Washington, D.C. and Tehran. Well, obviously, that didn't work because one of the vessels that was actually struck today was Japanese. The other one was Norwegian, just for your FYI. So something's going on here. And one of the questions that we asked during the political podcast was, cui bono? Who benefits? Does this make sense that the Iranians would have attacked these vessels? Do they want a war? Do they want to escalate to this volume? Excuse me, because who's going to win? Do they honestly think they're going to beat the United States of America? I don't think that's likely to happen. I think if we end up in war, Donald Trump will take the gloves off. I think he'll put the baddest generals in charge, and the gloves are going to come off, and it's going to get nasty. All war is nasty, no matter how you look at it. And again, I pray, and you should be praying too, in my opinion, that we do not go to war. We can't afford it. We do not need the loss of life. We don't need the loss of life on this side. We don't need the loss of life of our allies. We don't need the loss of life of the Iranians and anybody who might come to their side. We just don't need it. This is basically World War III if we get involved with Iran. Afghanistan was one thing. Iraq was another. Iran is a total different beast. And remember, if you're looking at a map, we got Afghanistan on one side, Iraq on the other, and guess who's smack dab in the middle? You guessed it, Iran. You think this is coincidence? Very interesting. We have to pay attention to this. And shockingly, not shockingly, but disgustingly, the stock market rallied on this. It rallied on this. We might be going to war. Good news. We love war here in the United States of America. That's what we stand for, freedom and democracy. Let's go all over the world and dominate. Let's go to war. The stock market loved it. It rallied. The small caps rallied 1% today. Dow Jones gained 102 points. You can't make this stuff up. You can understand oil spiking a little bit, up 3%. Of course, it pulled back a little bit. You can understand that because of the geopolitical risks. You can understand that. But the stock market going up, this is disgusting. We talked about this in the Cynic's Guide to Investing. In the era of too big to fail, it pays to be a cynic. And we devoted a whole chapter to this. War. What is it good for? We'll tell you. It's profits. You got a military-industrial complex. You got oil companies and energy companies that profit from this. And of course, the banks profit from this. And guess who did very well in today's markets? You guessed it, big oil and big banks. And that's what drove the price of these markets up today. This is disgusting, but this is reality. It's reality because the banks need to finance it. Energy companies are obviously going to need it. And if you have these geopolitical risks, the price of oil goes up and they're going to benefit. So this is another thing that you have to look at when you ask the question, who benefits? Because when you start to connect all of the dots of all of the economic puzzle pieces that we put together here on a daily basis to paint a very vivid picture of what is transpiring, not only here in the United States, but around the world, you have to ask yourself, what's going on with the debt markets? Because we talk about all the time about $10 trillion in corporate debt, whether that's bonds, commercial and industrial loans, leverage loans. Well, guess what? If you look at high-yield bonds, junk bonds, guess who owns a lot of those bonds? Guess who's issued a lot of those bonds? Energy companies, because it's very capital intensive and it's speculative in nature. Thereby, you have junk yields. They are junk bonds. It's a high gamble. And guess what you need to be able to pay off those bonds, which, by the way, are coming due in the tunes of trillions of dollars over the course of the next 4 years. We have these conversations here all the time. You need higher prices. Higher prices, higher profits, you can pay off your debt. Very, very coincidental, isn't it? That you need the commodity price of oil to be higher, or as high as possible, so that these companies can make profits, or at least have enough cash flow to pay off their debt. Now you have, again, the conversation of what the Federal Reserve may or may not do to cut interest rates. Well, guess what that's going to do? That's going to allow some people to kick the can further and further down the road because all of this debt is coming due. And of course, Uncle Sam is not free from ridicule because we got almost $23 trillion in debt and growing. So, lower interest rates are going to make those debt payments a little smaller. I mean, is that really what the United States has come to? We can't man up. We cannot show any type of leadership. We cannot be honest with each other and ourselves that we messed up, that we have for generations implemented and continued with very flawed and fraudulent economic policies from the federal government, the Federal Reserve, state and local governments. I mean, there is no responsibility whatsoever. Let's just kick the can down the road. Let's print money. Let's inflate. Let's steal the wealth. Let's steal the purchasing power out of everyday Americans. No problem, because nobody can tell the truth that we messed up. We can't keep these promises. Well, guess what's going to happen? Instead of doing this in some sort of orderly fashion, whatever that may or may not look like, you could at least have a discussion. You could at least be adults about it. And maybe people can be prepared and adjust accordingly. But no. We're just going to kick the can down the road. We're going to tell the Federal Reserve to continue to print money, as are the rest of the world's central banks. Because the rest of the world wants to do the same thing. They continuously want to kick the can further and further down the road. We wrote this in the book too. Despite the fact that the overarching theme of the Cynic's Guide to Investing at the time, which was published in 2015, was generally bullish, we told you better be careful because diminishing marginal returns will kick in eventually. That this methadone, this heroin, this crack that the Federal Reserve has been printing out of thin air and putting into the system, it will one day run out of steam. I believe we're at that turning point. Timing it is incredibly difficult because you can never underestimate the deceitfulness and the fraudulent nature of our federal government and the Federal Reserve, which is why I tell you guys almost on a daily basis, end the Fed and get rid of the income tax. You want to starve the beast, that's how you do it. You want to solve problems, that's how you do it. If nobody else is making those two comments, do not take them seriously, because all they are going to do is put a Band-Aid on a bullet wound. You need a surgeon to get in there and take care of you. You got to root cause this. You have to understand what the root cause of all of this is. You just have to, and that's it. This is how it all comes about. You want a better understanding? Get our book, The Cynic's Guide to Investing. Turn people on to the Capital News podcast because this is what this is all about. You're not going to hear this much of anywhere else. You're definitely not going to hear it on the mainstream media. You're not going to hear it on the financial mainstream media. Everybody out there, even some people who I have some respect for, are saying, yeah, you know what, I think the Federal Reserve should cut interest rates. I mean, I go against the president all the time on this. I voted for him because of his rhetoric attacking the Federal Reserve when he was candidate Donald Trump. That this is the largest wealth transfer in the history of the world. These low interest rates, this money printing, quantitative easing. Huge wealth transfer from middle America to people like myself, billionaires. We heard that from Donald Trump. We heard that from legendary hedge fund manager Stanley Druckenmiller. We hear this from people who at least have some dignity to tell the truth occasionally. Now Donald Trump is the president, and he wants the Federal Reserve to go back to low interest rates and another round of quantitative easing. You tell me how that is for the American people. It's not. It's for his pocketbook. It's for the pocketbook of Stanley Druckenmiller, people who own financial assets in a large degree. This is why you have our income inequality to the degree that which it is. And this is why we talk about Ray Dalio, the manager of the world's largest hedge fund, who says this is a problem because that's what his firm does. They're not all about tick by tick, minute by minute, getting in the market, getting out of the market. They're long-term, they're diversified, and they're financial and economic historians. That's what his firm is primarily focused on. And they study these cycles, and they study history, and they study, you know what happens when you have this type of inequality? Big problems. We talked about that report. Anticipate that U.S. corporate profit margins have peaked. They've peaked. So where are they going to go? If you're at the top of Everest, there's only one way to go, down. So they're coming down, and with it, most likely equity prices. They're predicting, of course, I'm talking Ray Dalio's hedge fund, 40% decline on U.S. stock equities. Exactly what we've been telling you months before that report came out. At least 40%. Going back to 2016 levels, I think it could be much worse. Not here to scare you, not here to be hyperbolic, not here to exaggerate, here to prepare you. Be diversified. You got a long time horizon? Stay invested. Build cash. Get into the precious metals. Hedge yourself. Protect yourself. If you're familiar and comfortable with shorting, do so, but do so carefully. That's all I can tell you. I mean, be prepared. Have a plan. When this thing rolls over, and believe you me, it will, despite how many times the president is going to come out onto the media to try to jumpstart the economy. If the stock market's going down, he's coming out trying to make statements saying, "Oh, we might move some tariffs away. We might suspend them indefinitely. We might have a deal with China." I mean, it's ridiculous. It's pathetic. In my opinion, it's an abuse of power, which I addressed in my letter to the president. So there's a lot going on. There is a lot going on. And I take it upon myself that it is my job here at the Capital News to put all of these puzzle pieces together the best that I can, to connect the dots, and to paint as vivid a picture as I can to tell you where we are and where we're likely headed. We also have another fund manager, Jeffrey Gundlach, who, again, I've mentioned him here before. Of anybody I listen to him. He came out today and just increased the likelihood of a recession taking place within the next 6 months up to 40 to 45%, and 65% of a recession taking place 1 year from now. So when this guy talks, I listen, because he has tended to be right. I mean, he's a billionaire. You don't become a billionaire by being wrong all the time. So it doesn't mean he's right all the time. He admits that he's not right all the time, but he's right enough of the time where he has proven very successful, and he has a very conservative strategy. Okay, but nevertheless, he has been able to make a lot of money for himself, his company, and his clients. So when Jeffrey Gundlach speaks, I tend to listen. Okay, I don't listen to a lot of people, but he's one of the voices I listen to. And when I saw that come across the news wires today, saying that he is elevating his view, his probability of a recession taking place this year or next year, you know, your ears got to perk up a little bit. You got to pay attention to that and say, well, you know what? We've been talking about that here for quite a while. So, I mean, we're not surprised. It just feels good every once in a while to have some sort of vindication from somebody who is such an expert in the field of investments. So, again, we could both be wrong. Maybe there's a melt-up in the stock market. That's still a possibility because we don't know what the Federal Reserve is going to do. Are they going to cut rates? Again, yesterday's episode was the Fed is confused. What are they going to do? You got 3.2% GDP in the first quarter. You have Larry Kudlow coming out and the president saying, "Oh yeah, we're still going to have 3% GDP growth for the entirety of the year." We have 50-year record low unemployment at 3.6%. We have inflation slightly below 2%, which means that they are stable prices. That means the Federal Reserve's dual mandate of full employment and stable prices has been achieved. So why do they need to come in with any type of rate cut, or another round of quantitative easing? Makes no sense whatsoever. Now everybody wants to say, well, it's an insurance cut. They're going to do this as an insurance policy. Where is that in their charter? Where is that in their mandate that that's what they're supposed to do? Interest rates are only at 2.25% to 2.5%. You got to be kidding me. This economy is the best in the world. This is the economy that is the best ever in the history of the United States, according to this White House, according to this administration. And our economy cannot take 2.25% interest rates? Give me a break. You do not have to be an economist to solve this riddle. This makes no sense whatsoever. None whatsoever, unless you understand what we have been talking about here on the Capital News for quite a while, that the president is looking for an out. He boxed himself in by taking ownership of this economy and the stock market, and he wants to point the finger at somebody else if and when this economy and or stock market turns over. And he found it. He had the endless wars. He's got political divisiveness. He has endless investigations on his administration. We have China, we have the Federal Reserve. He has his pick of the litter. He's going to take credit for all of the quote-unquote good news that comes out, but he is not going to take responsibility if and when this thing turns south. He's not going to do it. That's not his MO. It's not how he operates. So we have to be on the lookout for that, and we have to be prepared for that. Now, some other things that we're looking at here, we have the price of gold at $1,349 an ounce. That is another technical level, ladies and gentlemen, that is very important because $1,350 an ounce has proven to be rather strong resistance for the price of gold. If gold can bust through $1,350 convincingly and persistently, we may be on the verge of gold making a new run higher. So we got to pay attention to this. Silver, still below $15 an ounce, sitting at $14.93. The U.S. 10-year Treasury is down 1.7% for the day, now sitting at 2.091%. There are a lot of calls by people out there saying if this thing has a one handle, which just means 1 point something, 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 we're in trouble. Something's amiss. Something's going on here because this all gets back to our discussion on an inverted yield curve when you have shorter term rates yielding more higher rates than longer term duration notes, bills, bonds, what have you. Something we have to pay attention to because that's how the financial system works. It borrows money short, it lends it long. So when you have that inversion, that's why it has proven to be a reliable recession indicator. I actually saw an interesting tweet earlier today that another yield curve inversion that is under some scrutiny that people are paying attention to is the difference between the 3-month and the 5-year. And any time that is inverted for the duration of 1 quarter, so 3 months, that has proven recessions. That has been a reliable indicator. I'm going to look more into that, but that was an interesting tweet because that happened today. Not for the first time, but for 1 full quarter. So that is another recession signal that is flashing red, or at least yellow. You got to pay attention. This thing is slowing down. We have to pay attention to what's going on. Now, of course, President Trump's not going to tell you that. Larry Kudlow's not going to tell you that. Kellyanne Conway's not going to tell you that. Nobody in this administration is going to come out and tell you that. So you got to pay attention because we have the signals. We have the economic puzzle pieces. I'm just trying to do my best to tell the truth the way I see it. Okay? And this is based in the data. This isn't my conjuring up facts and figures to be hyperbolic or to make a point or to gain listeners. It isn't. In fact, me telling the truth and telling all these things probably turns a lot of people off because they don't hear it anywhere else. So they think I'm some sort of nut job in the woods saying what's going on here. But you have to pay attention to this. So again, I could be wrong. There could be a melt up in the stock market because who knows how the dingbats on Wall Street are going to respond to the Federal Reserve cutting interest rates. It's going to be interesting to see because they have a meeting next week. We're going to find out what they do. If they cut interest rates next week, that'll be a surprise to the market. The question will be how will the market respond because the market is anticipating a rate cut more so in July and most definitely later throughout the year, perhaps in September and probably in December. So we have to pay attention, see how the markets respond because, it's quite possible that even if the Fed does cut rates this month, next month, whenever, that this market could roll over because it could have a knee-jerk reaction to the upside. Maybe there will be a melt-up, but then markets are going to scratch their head. Well, why would the Federal Reserve do this? We're still at near record low interest rates. The economy was supposedly strong. Unemployment's 3.6%. Inflation is stable. What's going on here? You know, it's sort of when you sort of scratch your head, you sort of come to, oh, that didn't make sense, man. And now you sort of just have this epiphany. That's why it's so very difficult to time the market. And it's more or less a fool's errand. But I understand the temptation. Believe me, I try it myself. Sometimes successful, sometimes unsuccessful. But nevertheless, you have some money to play with. You want to take that gamble, do so, but be careful. Understand that it's very difficult to time the market. That's why I tell you, especially if you have a long-term time horizon, to stay invested in this market and allow compounding interest to work in your favor. A couple other items today. We have the VIX down 0.5 percentage point today, sitting at $15.82. Our leading indicators, if you will, also, in addition to oil, we have copper down a little bit, now sitting at $2.66. We have lumber that continues its rapid ascent and gained 5% for the day and now sits at $374 per 1,000 board feet of lumber. So that's interesting. I don't know if this is on the back of some stimulus measures coming out of China that we talked about the other day, or if something is taking place that perhaps I'm missing. But that's something that's interesting, because that's made quite the run over the past couple of days here, because that was below 300 maybe last week already. We have aluminum also down slightly, now sitting at $1,787. And aluminum is still, again, at multi-year lows and on the downswing. So that is still something that we have to pay attention to. Now, getting back to oil, conveniently, OPEC put out their forecast for the remainder of this year. And lo and behold, they cut their demand forecast. They're saying that the global economy is slowing down. Well, that's news to me, that the global economy is slowing down. No surprise, of course. I'm being sarcastic. We understood the games that are being played. So even OPEC understands that the global economy is slowing down, and they are lowering their projections for demand. Now, it's going to be interesting to see how OPEC responds to these geopolitical risks, how they respond to their own analysis of slower demand. Will they continue with their production cuts? Because even if their production cuts, even along with Russia, have somewhat been overtaken by the production here in the United States of America. So again, demand, supply, the value of the dollar, and geopolitical risk. So we got to pay attention to all four. Now, something I wanted to get to today, but we're not going to have enough time, obviously because of the geopolitical news that took place in the Gulf of Oman this morning. But I wanted to mention that we have, according to Bloomberg News, we have, I believe, over $10 trillion in negative yielding debt. Now, barring something else from taking place tomorrow, that is something that we are going to discuss hopefully tomorrow, and the ramifications for what that means. Will we have negative yields here in this country, as is the case in Germany, as is the case in Japan and some other countries? It's something to discuss. It's a big economic piece to this economic puzzle. And so, again, barring some sort of other geopolitical risk or something else out of right field, I will do my best to mention again and go into a deeper dive with $10 trillion in negative yielding debt around the world and what that means for us. Thank you so much for joining me. Ladies and gentlemen, it's been a pleasure having you. As always, please like, share, subscribe, get the word out. Be sure to check out episode 83A, War Drums Playeth, because this all ties in together. This is the Capital News. I am Alex Koritis. Godspeed.